Hi, everybody. I hope everybody's having a great day on this Friday before Memorial Day weekend. What I'm here to share with you is what's the latest and greatest with the fundamental changes to our tax system that are going to be happening with the big, beautiful bill. And, some of the other things that have happened with the original Trump tax law, and just in terms of like a recap, so we can get a sense for the impact of this big, beautiful bill. Now, I'm going to be covering things pretty quickly. There's only 134 slides for us to deal with, so it is a pretty comprehensive strategy, okay? Some of it is going to be limited into scope in terms of what's going to apply to a lot of business owners that we work with and a lot of people in that same type of arena, right? So, but I think it's going to be very interesting. First, the original Trump tax law, the Tax Cuts and Jobs Acts of 2017 significantly reduced the corporate tax and individual tax rates, and many provisions were set to expire December 31st, 2025, right? So and a lot of them were phasing out in the last few years, particularly when it comes to depreciation. The 100% bonus depreciation was pretty exciting when it came through at the time and really spurred a lot of business investment. And I think there's certain elements of this bill that are also going to have that impact. Then, of course, tariffs, man. I don't think there's any shortage of discussion and/or crazy activity that's gone on with surrounding the tariffs. And I think, Trump in negotiating in public was probably not the best thing to do, and set the markets going left and right and up and down. And who knows where it's going to end up. But it's going to continue to have an impact for certain. And then we have the one big, beautiful bill, as it's now called, that has, in some marathon sessions, has gotten through Congress, and we're ready to have the Senate take it up. It looks like they're still targeting a signing date of July 4th. Okay, so I think that's going to be pretty interesting. The Tax Cuts and Jobs Act, the TCJA of 2025, was all set to expire. Rates were going to be set to pre-17 levels for individuals, reduction in standard deduction, return of personal exemption, the end of the SALT limitation, and expiration of the 20% pass-through income deduction, the Section 199A, which is also known as a QBI deduction, qualified business income deduction. There was a real cliff on this, and that they were going to trigger significant tax increases for individuals and really small businesses unless this was extended or reformed, which is really one of the reasons why the big, beautiful bill was really being considered and happening. Talk about tariffs a little bit. Man, he announced a 90-day temporary suspension of tariffs aimed at easing the pressure on U.S. businesses and consumers. And, it's just covered a wide range of imported goods, especially from China. And they were previously subject to elevated tariff rates. So, that window of relief has calmed things down quite a bit. And I think they're going to go through a period of negotiations right now. And it allows the opportunities for businesses to stock up, prepare for more tariffs, and prepare for the tariffs to potentially resume. I think it was today in the Wall Street Journal, Trump threatened another 50% tariff on the EU products and also on Apple devices, of all things. So I don't know what he's trying to get these people to do. It's not clear from that in terms of the EU, bring them to the bargaining table. And Apple, I'm not sure why he's targeting Apple products, but there's always a reason behind what he's trying to do. Good, bad, or indifferent, there's a reason. So, we're looking at a significant impact to the economy, right? So, unless the extended tariffs could return with higher rates and a broader application, adding additional costs across industries. I think this is what a lot of people are really afraid of, and I think the broader implication of the tariff situation and what he did is trying to scale back or significantly cut the globalization of the economy. And really what he's trying to do, and we'll see that in some of the big, beautiful bill, and what he's trying to do to help spur reinvestment and manufacturing in the US again, right? Obviously, there's a lot of areas that are vulnerable. The tech and software service subscriptions are vulnerable to tariffs. Many essential platforms and software tools rely on international infrastructure. Could be very, very interesting in terms of how that happens. Imported equipment could be higher capital cost if you're planning to buy computers, servers. Yeah, sometimes even ergonomic office gear. Tariff resumption may mean higher replacement costs for up and upgraded higher replacement and upgrade costs. Outsourced teams and contractors may adjust rates as well. International consultants, virtual assistants, and fulfillment partners might raise prices in response to their own economic pressures. Margins can get squeezed even without imports. The result could be lower profitability and increased unpredictability of pricing, which is challenging. Now let's get to the meat of what we want to talk about is the one big beautiful bill, right? And I wanted to go over some of the provisions with you on this one big beautiful bill. There's a lot of changes that I think is going to be very interesting to how they can apply. And I'm looking through this and reading through this and going, well, there's some more loopholes in here for a lot of business owners that could be very, very interesting. Tax credits and deductions, okay? So, we're starting at the individual level, right? So these first grouping of slides is the individual level of tax returns, right? So not your business tax returns, but what comes down and what you actually pay when you file on your W-2 or your K-1 and your business income, your individual tax return, single or married filing joint. The permanent standard deduction increase has been made, and it was the one that is going to be permanent starting in 2026. We're looking at 15,000 single, 30,000 married. There's going to be a temporary increase that adds an extra amount for 4 years, 1,000 for single. I mean, it's not a big deal, right? 1,000 for single filers, 1,500 for head of household, 2,000 for married couples. So instead of 30, you're looking at 32,000 married filing joint. Effective dates applies to taxes filed from 2027 onward, which is the 2026 year. Temporary increases apply to 2025 to 2028. Termination of deduction for personal exemptions. It used to be way back in the day, and I'm going to say 2016, where we'd have personal exemptions of $4,000 per family member and so forth. Those are all gone. And they replaced that with the higher standard deduction, right? And it also prevents those from being reinstated, right? So this effectively terminates the personal exemption portion of the tax law. Extension for increased child tax credit and temporary enhancements, right? So the TJCA changed the child tax credit to $2,000, and there's going to be no expiration of that. But there's going to be a temporary increase in that tax credit that takes up to $2,500 per child for 2025 through 2028. But they have stricter, and you're going to see this throughout the bill. They really have stricter Social Security rules, right? Because what they're trying to do is making sure that people that don't have Social Security numbers and may just have TINs don't get the benefit of all don't get the benefit of all the positive changes out there. The refundable portion of a child tax credit is up to $1,400. Okay, so if you're not essentially making any money and don't or you've overpaid on your taxes, your child tax credit you won't get refunded back to you. Okay, and then the base credit at $2,000 after those temporary adjustments will be adjusted for inflation starting in 2029. Right, so 2025 through 2028, it goes to $2,500 per kid. And then 2029, we're looking at $2,000 plus inflation, okay? So limitation of tax benefit and itemized deductions replaces the PEAS limitation, which is the old rules, 3% reduction of itemized deductions for income above thresholds. And this is one of the things that people need to understand. When you have a very successful business and you're pushing through money for your K-1s into your personal returns, they start to limit what you can itemize, even if you have high itemizations. A lot of people, when they're very, very successful, they want to give a lot of money away for charity, and what they can write off will be limited because of some of the income limitations here. So this really applies to the 37% tax bracket, which, is about $600,000 of income, married filing joint. Once you get up into that range, I think it's 600 or 650, you will have some of these limitations put in place in terms of your itemized deductions. Deduction value is capped at $1 for each of itemized deductions. Reduce taxable income by 35 cents per dollar, right? And effective date is 2026 and beyond. So extension of limitation for deduction of qualified business business residents. Okay. If you will remember that, any mortgage above $1 million, the interest deduction is not valid, and this takes it back down to 750,000. So if you have a mortgage above 750,000, the interest paid on that 750 on that amount above 750,000 is not subject to. You can't write it off on your Schedule A, right? It's not a deductible expense anymore. So this is 2026, right? And you can't deduct any interest on a home equity loan unless you use those funds to buy, build, or substantially improve the home income. So there's a lot of situations where you know it may happen to be, especially here in California. I mean, if you're a successful business owner, you have a significant property that you've acquired for your personal residence. I mean, 750,000. I mean, you're looking at anything really above $1 million home, which, is not that hard to do in California anymore, especially like Southern California, for example, and the Bay Area and so forth. I think the average price of a home in San Francisco is well above $1 million. So it can have a significant impact. Okay. Casualty losses, it makes the casualty loss limitation, which means basically if you have a casualty loss, you cannot write it off. So it permanently extends that the casualty loss limitation, in that you can't write off any losses that you have unless they're related to a national disaster, a publicly declared national disaster. For example, hurricanes, wildfires. So for example, last year when LA was burning, or earlier this year when LA was burning, a lot of people had significant casualty losses. Those would be you could write those off. Okay. But if your house burns down and it's not part of a natural disaster, you can't. Okay. So, that's making that permanent. That was part of the TCJA, right? That was part of that tax reform. So you can't do it. Here's an interesting one, right? No tax on tips. Okay. And, what they actually do to make this work with no tax on tips, they allow people to deduct their tips as a deductible from income, which means, let's say you're a wait person, bartenders, beauty services, hairstyle, whatever, people that traditionally get tips, and that's what they really want to limit this to. Those people that traditionally get tips. So it's still going to be subject to self-employment tax as part of your income, right? But it's not going to be income taxable, right? So you'll pay FICA on those tips, provided you're under the FICA limit. But also it has exclusions for highly paid employees, 155,000, and tips from a specified service business, which is what we call the specialized service trader business, SSTB, like the law, consulting, your favorite accountant that you may want to tip, all of those things are excluded. Okay. So, unfortunately we can't get tips. Or we can't not exclude the tips from taxable income. So, non-cash tips and tips generated as negotiated as a part of wages are also excluded. So let's say you have a specific negotiation where every time somebody, does a certain amount of revenue, or let's say you have a deal with a wait person that regardless of what the patron of your restaurant tips, they're going to get 15%. So that would be like a negotiated tip. So if the person comes in and only tips them $5 or 5%, you're going to give them 15. I've never seen that actually. So I've seen a lot of people work tips and do it correctly, but it's not something that you can negotiate in. And I have seen some restaurants where they insist on a specific level of tips or an automatic service charge. I still don't think that qualifies as something that's negotiated separately, right? It's just like those times we have parties, a group of party over 10 or whatever, and they apply an 18% service charge. Yeah. So, strict reporting for employers, right? The tips have to be broken out separately on the W-2. Okay. So this is something that needs to be like really put in effect right away, right? So you got to make sure they're broken out on the W-2, and I'm sure that all the payroll companies will make sure that that's compliant, right? So they currently are, in most cases, reported separately in the W-2, right? Because they're also reported separately on the 941s and everything else like that. So if you don't have a completely compliant payroll system, you need to get one to make sure this happens for your employees. Otherwise, you might lose employees that'll go somewhere else. And then the anti-abuse rules prevents reclassifying wages to tips to exploit this deduction. And deduction takes place now, as soon as the bill is passed. Oh, no tax on overtime. This is another big one, right? And it should be really, really important. And it's treated the same way, okay? So as any overtime that's broken out separately, right, on a W-2, they'll be able to deduct it from their income. So again, it's still subject to FICA, still subject to Social Security payments, but it is. You also have the same threshold for highly compensated people. Anybody making above $155,000 cannot take that deduction, right? Key rules, again, the same thing. We're going to see this all the way through. That's Social Security requirement, right? So people cannot get this deduction unless they have Social Security numbers. Again, TINs will not work. And overtime pay must be listed separately in the W-2. Box 12, coded OT. Non-itemizers can also benefit. So, a lot of times you have the itemized deduction. In order to get that, you have to pass a certain level of itemizable amounts, right? Like if you have a house and you have your property tax and everything else like that, you can probably get over the limits, the standard deduction limit, right? If you can't get over that limit, you can't take it. But this is treated, the tips and the overtime rules are very, very different. So even if you don't individually itemize, you can still take these deductions. And again, this applies to 2025 and has a sunset clause for 2028. Strangely enough, a sunset clause very close to an election year. Very interesting. Okay, so and enhanced deductions for seniors. Now, one of the other things that was proposed by Trump when he was campaigning was no tax on Social Security. Well, this is gone. Okay, that did not make it through, right? What they did to make up for it for the seniors was give them an extra $4,000 added to their standard deduction. I mean, it's not a lot, it's something, but the seniors lost the tax-free Social Security income, which, in general, that Social Security income to be taxable is, it's money we all paid in to begin with, right? The employers and the employees that contribute 7.265 of their income into FICA. I mean, it's our money that we put in there. So, it should be like a regular retirement plan, but it is what it is. And to a certain extent, that's all tax-free contributions anyway, because it's deducted from your income. It's not necessarily included, right? So, especially for employers, for example, they deduct their FICA contributions from their tax returns. Phase out on that. When people hit 75,000, married couple hit 150,000. So, I mean, the extra 4,000 is not bad. I mean, it's something, right? But it's not full tax-free. So unfortunately, they didn't get through for that for the seniors. Because I know a lot of seniors who, they've worked very, very hard their whole lives. They got a tax return, and now they're having to pay tax on Social Security, which feels like pretty much to everybody, hey, that's not fair. Okay. Here's the new one. No tax on car loan interest. So the limitation is $10,000. So you can deduct your car loan interest up to $10,000 a year, right? Cars, minivans, SUV, pickup trucks, motorcycles, ATVs, and RVs, right? So even if you have some personal equipment like ATVs or an RV, although an RV, a lot of times you can classify it as a second home, but let's say ATVs, right? You can deduct it. Here's the catch, though. The final assembly must occur in the U.S., right? So excluding certain foreign-made vehicles, right? So if you brought in your, Mercedes made in Germany or whatever, and it's not manufactured in the U.S., that you can't deduct it, right? And there's also a phase out, right? It's only for people with a modified gross income less than 100,000, right? Um, so, and for people who make over 100,000, it goes down by $200 for every $100,000 you're over your limit. So it's pretty complex. I mean, they're adding some additional complexity to the tax code here. There's no question about it. Excluded leases, salvage vehicles, fleet vehicles, and so forth. Um, uh, and loans from related parties. So dad can't loan you money to buy a car and you deduct the interest that you pay your dad. So, or vice versa, your kid loans you money to do a car. It could be a dream come true if your kid loans you money to buy a car. Oops, hang on, let me go back. I lost my place. Seniors, we did that. Car loan interest. Adoption credits. Okay, so they've expanded the adoption credit, right? So if you adopt, I mean, the main thing you got to know that there's a credit out there for you to do that, and the credit is about 17,000 bucks, right? So most of it is uh, uh, non-refundable, but there's a significant credit out there. Not a lot of people take this because there's not a lot of adoptions that happen. There's some phase-out rules and so forth. But it's out there as an additional and more expanded benefit, right? Tribal Indian governments, there's some additional interesting things that's going on in terms of not only this one where they allow some kids to be special needs and they get the tribal government to do that. So that's an interesting development, but they also have some other things that we're going to see on the development of low-income housing, which could be some opportunities down the road, and I think it could be some benefits. Um, Now, this is kind of an interesting one too, right? So you're allowing a tax credit for contributions to scholarship granting organizations. So let's say you feel generous at the end of the year, you want to get a tax credit. You are able to get, if you donate to a scholarship granting organization, an SGO, you can take a 10% tax credit. Okay. And you can take up to 10% of the adjusted gross income, right? Or $5,000 a year, right? So if you contribute if you have a $60,000 AGI, adjusted gross income, you can deduct up to $6,000 for contributions. Corporate contributions are capped at 5%, and there's some carryover rules that are beneficial. I mean, this is eligibility is for households that have income less than $100,000 a year. And this theme we go through almost all of the tax code, and always has been this way, but it's a little bit more stringent now, I think, in this rule, because they are limiting deductions to people who have higher incomes. Qualified expenses, private schools, religious schools count. Again, you have to use the SGO. The SGO is a separate organization that cannot, like you see this prohibition here. If you're thinking about, hey, I'll form my own SGO and I'll just put in money for my kids and we'll write that off and get a tax contribution, right? Yeah, they said there's no earmarking of donations for specific students, right? And these SGOs have to be audited every year. Okay, they have to do certain rules when it comes to prioritization and so forth. And there's an annual federal cap on the total amount going into this program of $5 billion. Additional elementary and secondary and homeschool exemptions treated for 529. This one is kind of interesting, right? Now, it used to be you could not use a 529 plan. And a 529 plan, for those of you that aren't familiar or haven't used it in the past, you get to put money in to a 529, and the growth of that money is tax exempt, right? Or tax free, right? So, but if you take the money out and don't use it for education, right, it is going to be taxable income. But if you take it out and use it for education, any deductions from that account will not be taxable, right? So this greatly expands the use of 529s, right? And what you can use the money for. So it could be interesting, right? If you have some highly appreciating assets or assets you think are going to appreciate a great deal, put them into a 529 to take care of the kid when the kid gets to school. And, it basically will let you take that money out of the 529 tax-free, right? So you got homeschooling, you got tutoring, you got standard tests, there are a bunch of different rules that really open it up. So they now include all these different rules, okay? There's some requirements, like if you're going to pay your kid to do tutoring out of a 529 and have it be tax exempt, this has to be a state licensed former teacher or a subject expert, okay? I don't know how you're going to how you determine what a subject expert is, but you probably need to have some qualifications that go along with that. Certain post-secondary credentialing expenses are also now treated as qualified higher income education income expenses that also work with a 529. Tuition, we have obviously, whoops, let me go back. We have tuition, books and supplies, exams, and continuing education costs that can also come out of a 529, okay? Again, applies to distributions made after May 12, 2025. So we're reinstating the partial deduction of charitable contributions. Now, that's not a big one, but if you remember during COVID, we implemented a special deduction for charitable contributions, and this basically brings it back. Okay, so $300 are above the line. You don't have to worry about doing a qualifying for the itemized deductions. You don't have to worry about that at all. You can just go through and take that $300 above the line. Extension of rules for treatment of certain not disaster-related personal casualty losses, okay? Again, this is like, we can have casualty losses if they're in a national disaster. Again, it's for federally declared natural disasters, right? It gives us a 10% of AGI floor, okay, which means that once they exceed 10% of your AGI, it starts to come into play. And the threshold losses are $500 per incident, okay? And non-itemized deductors can still claim this deduction, okay? So if you don't have enough to itemize, you can still take the deduction. Here's kind of a big one that they've talked about a lot. And I think this is basically in the latest round of the bill, which has happened in the last few days, the SALT limitation, which was driven down to $10,000 per individual taxpayer, is now been lifted up to $30,000 married filing joint, okay? And it starts to phase out once you make a lot of money, okay? Or what Congress has determined a lot of money. With incomes over 400,000, that starts to phase out as well, okay? So it is, an interesting change to the SALT deduction, okay? So it was previously going to be 30. I think it's going to be 40,000 by the time the final bill goes through. We're in final negotiations, so we'll see what happens as it all comes through. The SALT caps, we have certain exclusions for foreign income, right? Only deductible if tied to U.S. trade or business, right? So if you have foreign income, you won't be able to take some of those deductions. You have state taxes paid as pass-through limitations flow through to owners and from the S corp. That is also going to have an impact to the tax losses, okay, or the ability to write those off, okay. So they have new penalties. There's no capitalization, okay, and it applies to tax years beginning 12/31/2025. The MAGA accounts, which a lot of it's kind of an interesting way to do things. I'm not sure there's a lot of value there, quite honestly, but it lets you open MAGA accounts that are tax advantage accounts, tax advantage in the sense that they don't write off the deductions, but it grows tax-free. And it's designated for, if you withdraw these appreciated amounts out for education, home ownership, or small business ventures, then you're going to be exempt from taxes, right? And it's growth oriented. Tax-free growth is really what it's all about here with this one. And education, home purchase, home small business opportunities. Uh, if you have a non-qualified distribution of that, it's almost the same as like a IRA where you withdraw too soon. You're going to face those penalties. Interesting part is the limitations are, as of 18, there's no withdrawals allowed. 22 to 24, you have limited withdrawals up to 1.5% of your total account. And age 31, you can withdraw whatever you want to and still have that benefit of that tax-free growth in that account. Okay. There's some anti-abuse measures. Again, we are looking at the situation where there is a Social Security limitation. There are like these accounts are made for minors, and they actually include, hang on, they actually include government payments into these MAGA accounts. This is the interesting thing is that they're doing that they establish these government-funded accounts for savings in a pilot program for children born between 2022 and 2025 to promote long-term financial security, right? So the IRS will actually, and the IRS, if they can do it, and I say if they can do it because the IRS has got a lot of problems right now in terms of trying to make things happen. But for kids born between 2025 and 2028, they can get this $1,000 one-time deposit to the MAGA accounts directly from the government. I mean, it's not a bad thing, and they're going to do it automatically. So it's kind of an interesting. I have a question as to whether they're going to be able to do it, right? So there's a lot of eligibility. Again, U.S. citizens. Again, the guardian must file taxes and have Social Security, right? It's a trustee situation with the IRS is going to assign to a financial institution the management of these accounts, right? So, and the parents have preference, if they want to provide those preference. So, I mean, and there's regulations related to incomplete claims and everything else like that. I don't know how that's going to work. To me, it seems like a lot of work for a relatively small amount for $1,000 per kid. I mean, it's $1,000 is $1,000, but you get to be able to exclude that income over a long period, right? So if the kids are born now, you're looking at 31 years of growth. Could be interesting. Could be interesting. Business deductions and credits. This is kind of one of my favorite areas because it's really what we specialize in terms of making sure our business owners are taken care of. We're looking at a permanent QBI reduction and putting that in place of 20%. Not only are they putting the QBI deduction into 20%, they're increasing deduction to 23%. So this has a wide impact into the calculations of whether or not what your business should be. Should it be a C Corp, S Corp, LLC? You're always going to have an impact to this. And I think it's going to be very, very interesting for us to really consider this, right? Again, they have below threshold exemptions, right? So full deduction for taxpayers with incomes under 191,000 single, 383,000 married, and above 75% of excess income over threshold reduces deduction limitations, right? So when you have a business and when you're running, and you got to think about this too, because from year to year, we have different times that happen. Let's say we have a business that sells a piece of property and it runs through your personal return because it's an S Corp. You have a big gain and a lot of these limitations can disappear, right? And there are also some calculations to the BDC interest income for business development companies. That is not going to be a big impact to a lot of people. And it also allows for the inflation adjustment of these amounts to allow them to use the QBI deduction, and it applies to 2026 and beyond. Okay, so this is kind of a big deal. The going from 20% to 23% is going to be impressive and hopefully reduce our tax rates, right? However, at the same point in time, if we go above these limitations, we're going to lose those QBIs, right? So those computations are pretty critical, and it's always been very tricky and very critical because you have to look at a number of different applications, right? This is also another really important one. It's the permanent change of the estate tax, right? Now, everybody that has an estate, right, or some people that pass away, right, have the have a one-time step up in basis for their estate, right? So what the government does is they look at all of your assets, they adjust it to market value, and if your estate value is above $15 million, they're going to charge you death tax, right? They're going to charge you your estate tax, which is about 46%, right? If your amount of the estate is below $15,000, that's your exemption, right? That's your estate exemption. And so if somebody passed away, that $15 million is going to be not taxed on the estate tax situation, right? So that estate tax is really, really important because it's not only your exemption from estate tax, but it's also your gift tax exemption. So you can gift anybody up to $15 million per person of your estate or of your building in terms of estate planning. And there's a lot of, with the baby boomer generation, there's a lot of people trying to plan their estates and give away money to their kids. So there's a lot of things to think about there. And it's $15 million per person, $30 million per married filing joint. Okay. So it applies to states above December 31st. Now, this was scheduled to wind down, right? After uh, the 2017 tax law. It was scheduled to go from 13 million down to 5. So a lot of people were really nervous about the expiration of that estate exemption. And people and people had a lot of questions and a lot of things that we've talked about in this for quite a while. And we actually had to do calculations and everything else like that. So people were worried about it. So the good news is that this is now brought up to 15 million. 15 million single, 30 million joint. So that'll be a good thing. Alternative minimum tax, we're raising the exemption, which is good news. So people will not be applied to a phase out that begins with income of 1.2 million, and the exemption is 85,000 single, 133 married, and it prevents the cliff from dropping off where people are going to drop off, and be subject to alternative minimum tax, which is a separate tax system really within the system and can be very, very expensive. This is also, I think, pretty interesting. The enhancement of employer provide health care. So if you have, and I'm thinking about looking at this in terms of, if you have employer provided health care, you get to take credit up to 40% of childcare expenses, up from 25%, and 50% of its eligible small business healthcare provided for a child. There's some pretty good deductions in here, right? So let's say you're running a small business, you're trying to be competitive, and one of the things you want to do in recruiting people is get some people and provide healthcare for their childcare for their kids, right? They're trying to run their business and stay involved. You're trying to run your business and have your employees stay involved in the business. So there's some pretty good deductions in here actually to get those credits, right? There's also some opportunities to partner with third-party intermediaries on this, using joint facilities to share. And sorry, went back and forth. Okay, here we go. Writing off buildings, operating costs, and scholarships for also low-income employees. So there's quite a bit of write-ups for here. If you want, it could let a small business owner be competitive, right? And to really allow them to do it. There's extension of the Enhancement and Family Paid Leave Act, where you can get insurance, you can pay for the Family Leave Act and actually get credits for that, right? So it looks like some of the wages are up to 25%, 12.5 to 25%. And insurance premiums under this could also be from 12.5 to 25%. They're credits, right? So credits are really good things because they're directly deducted from your tax bill. So some really good opportunities, right? There's another very interesting one that a lot of people can use, right? And it's kind of a little bit of a loophole because you can actually pay your employees in tax-free money to help them pay for their student loans up to $250 a year, right? And it's permanently tax-free money for the employees, okay? That's pretty interesting. And it's inflation adjusted as well. But it's like, if you think about all the different little loopholes that you can do, this is one. The Augusta rule, home office reimbursement, paying the kids, all these other things that you can do, they add up after a while, right? And if you have a tax rate of 30%, right, or 40%, and you're taking these loopholes, they ended up, all of a sudden you're looking at $40,000, $50,000 of tax-free income if you use them all. So this is pretty interesting. Health reimbursement is another one, the HRAs, right? Which is the makes individual coverages flexible and alternative to traditional group health insurance. So let's say you're a small business owner and you don't really want to get an outside health insurance coverage, right? You don't want to have a group coverage. Well, you can fund the HRAs to pay for individual coverage and really like use the marketplace, right? And it lets you take write-offs for the HRA. Non-discrimination, obviously, this is what's in this bill all over the place. There gives some flexibility, and it's also portable for you to take these funds and move them around and be able to take it with you so they can spend them down to use to pay off your insurance, or pay your other medical costs. So it's interesting, again, December 31st, 2025. All right. So, yeah, it's kind of interesting, kind of an interesting opportunity. Again, there's no mandate to do that, but there are choices that you can use. They're also eligible for the exchange cafeteria plan. Like for California, you're looking at the California exchange, or many, many other states have it under Obamacare or what have you, right? So the tax savings can be somewhat significant, right? So we can lower taxable premiums by $6,000 a year. So there's some interesting opportunities there. A lot of good employer credits from that. I'm sorry, I got to go through a lot of different things we can do. This is a big deal. This one is the big deal, I think. It allows 100% bonus depreciation for business to write off business assets, right? We can immediately deduct the cost of qualifying assets, machinery, equipment, et cetera, through December 31st, 2030, okay? So general assets, long-term productive assets, they have to be acquired by December 31st, 2030, right? And, all of these different things that we can take, general assets, long-term, plants and trees, orchards, and so forth. There's no gradual phase out. The last few years we had a 80%, 60%, 40% phase out of that. That's no longer the case. We get 100% bonus depreciation. And it applies back to January 19th, 2025. That 100% bonus depreciation of anything you buy that you can get right off right away is a great thing to have, right? Binding contracts are protected, right? It boosts cash flow for business by investing in equipment, manufacturing, agriculture, and transportation. Applies to assets acquired and placed in service January 19th. So if you bought a truck, you bought a bunch of assets, you bought an SUV, SUV over 6,000 pounds. We all remember that one now. We always drilled into us, right? So that's there again for us to take again, right? So here's really an interesting one. Again, this is one that goes to manufacturing, right? So there is 100% immediate bonus depreciation for qualified production property. This one is really more important and kind of a sleeper code in here. So business can deduct 100% of the cost of qualifying property in a year it's placed in service, right? Applies to non-residential real property used in manufacturing, production, or refining of tangible personal property. So let's say you decide, you know what? I am going to build a factory or a place where I manufacture things. Or let's say I'm going to build a machine shop, right? And I'm going to buy a building for $1 million to put my machine shop in. And guess what? 100% bonus depreciation for that building. Okay. Most of the time, your 100% bonus depreciation is for assets of 20 years or less, right? This is for production. Again, this is something to encourage people to invest in manufacturing. Now, what is manufacturing? So let's say you happen to be in the business where you like wine, right? And you're a successful agricultural business and you're like, you know what? I want to open a winery or I want to start making wine. Guess what? Your entire winery is a productive production asset and can be written off, right? Has to be in the US, right? So that's kind of interesting. Excluded property, office spaces, admin, lodging, parking, sales, research, software engineer, activities unrelated to manufacturing production, right? Or things subject to other special depreciation rules. But the acquired property has to be bought in between 2021. Sorry, it qualifies if it wasn't done in the construction window of 2025 to 2029, so the next 5 years, and requires special transformation of tangible goods, i.e. manufacturing cars, limited to agriculture, chemical production. So ag qualifies. This is where our wineries can be. So, or the conversion, or a production. Let's say you're a huge almond person or a pistachio person or whatever it is, and you're converting the property, like you're shelling almonds or whatever. All of this stuff will work for bonus depreciation, right? It's a big deal because normally that product is 39-year property. Low income housing credits. This is very, very interesting. Remember I talked about, the possibility of putting low income housing in certain places, like, for example, in our 2030 until 2030 rural regions of the US and Native American lands that qualify as hard to develop can grant a 30% tax credits, right? Tribal products may involve tribes using federal housing programs. So you got a 30% tax credit, right? For the building of low-income housing, right? Some easier to finance rules, some new priority areas, the effective dates, 2026 to 2029. That's going to be some interesting opportunities. A lot of people like to shy away from low-income housing, right? And sometimes they do it because they feel like it's not worth it. But if we're looking at low-income housing, that gives you a 30% tax credit, right? You could see some opportunities there. Okay. So there's some modifications to that low income housing credit. And rent, there's no question, as a society, we definitely need low income housing. There's no question, right? The whole NIMBY, not in my backyard thing has phased out, right? So now we're going to business deductions and credit. There's a limitation and deduction of moving expenses. This is They eliminated it last time in the last tax law, and they're eliminating it again, or reaffirming that. Gambling losses, you can only use them to the extent of winnings. Okay, so if you have to make sure you've got to keep track of your losses when you have your W-2Gs or whatever. We have a lot of terminations through this, right? Termination of qualified bicycle commuting, which used to be part of the tax law. You're going to see a lot of this type thing in this tax law, right? Extension of exclusion of credits from gross income, student loans discharged because of death or disability. A lot of small things that they just cleaned up, right? I already covered that, wager ones, right? Exclusion on interest of loans secured by rural agriculture property, a bunch of different new rules on that. This is a substantial bill. It's an interesting one. So if you know anybody that likes to have a sound recording studio, there's always stuff like this that gets into a tax bill. Like you scratch your head and I go, what do you mean? We're gonna have certain qualified sound recording production facilities that are going to be expensed instead of depreciated, even though a lot of this is going to be covered by the depreciation rules. So it's a very, very interesting situation. But if you have somebody that's working on building their own little sound recording studio and they want to write it off, that's all good. Go ahead and do it. Health and medical care, health savings accounts. Okay, HSAs, big changes, okay? I think the big thing there's a lot of different rules with HSA, but HSAs are a way to work with, and I'm gonna kind of cover some of the basics here, but there are so many different rules related to HSA, right? That increase the level of amounts that you can write off, okay? So the amounts are up to $9,200. That's a significant increase. Let me see what the other totals are. Yeah, $9,200 for catastrophic plans. So it's a way to set aside tax-free money under an HSA. The HSA is a great way to set aside money because it becomes like a separate retirement account. It's one of those things where what you contribute to HSA is tax-free, right? And it grows tax-free. So it's going to be a really interesting opportunity, right? On-site employer clinics. Man, if you want to have an on-site employer clinic for these activities, there's also deductions and credits for that. Certain amounts paid for physical activity, fitness, and exercise amounts in medical care. You know, HSA and fitness funds allows HSA accounts to cover qualified sports and fitness expenses tax-free up to $500 a year for individual, $1,000 for employees. Again, another small write-off and a small loophole that you can take advantage of. Gym membership, personal training sessions, golf, hunting, sailing. So if you want to write off your golf, hunting, and sailing and riding facility, go ahead and do it. That'll be a lot of fun under your HSA. But it's really kind of interesting that they're letting more and more areas to do that. The HSA is the house spouses can make up contributions to the same health savings accounts. I have 9 minutes left. Is that right? I told you this was a big deal. This is hard to get through and to try to dump as much of this as I possibly can. But HSAs are going to be interesting, right? So it's like I said, another way. And you look at the FSA and HRA terminations of coverage, and you look at your limitations. Whoops, let me go backwards. 3,200 single, 6,400 family, the contribution limits, right? So when you start to think about, again, you know, you got individual situations. You can make contributions, $5,400 for your kids, you know, payments for your student loan payments. You can do $3,200 for your family coverage for HSA, $6,400 for family coverage HSA. Sorry, single is $3,200. So, you know, just those two alone could be 10 grand a year of tax-free money, right? And that's what we want to be able to figure out how to use. Okay, a lot of different ways to work through this stuff. And when you look at the details of this, there's a lot of details. So we're going to have to work through this, and we're going to have to plan it out, right? So HSA contributions, $4,300 for individuals, $8,550 for families, right? And you have, again, the phase out with AGI. This is one of the things, I mean, AGI is so important with all of these new ramifications to the tax law. And sometimes you may want to be able to use all these, and you may need to be a C corporation to take advantage of that. So, because C corporations is a way you can limit and control the amount of income you actually have on your personal return. Pretty interesting. Inflation adjustment, business tax investments, depreciation. This is very, very interesting. Now, the R&D tax credit, so many people don't use the R&D tax credit, right? And it's basically basic research. You are able to write off 15% of the amount you spend for R&D. And one of the things that qualifies for R&D is software. So software development, for example. So let's say you want to figure out how to make your business more efficient, and you want to start using AI. I would hire an AI person and put this person as your R&D person. And you can write it. Used to be this is what they used to do before this act that's going to come into play. You would have to set up your R&D and amortize it over 5 years, and then take the credit, the 15% credit. Well, now you can directly expense the R&D plus take the credit. So let's say you spend $30,000 on R&D, you get a 15% credit, which is $6,000 credit against your taxes, and then the other 85% of that $30,000 you're going to write off directly. So that's a big change. That's great. It's again a situation where this bill is really focused on manufacturing and R&D and creating more jobs and more productive capabilities. We saw that in so many. I mean, 100%. And I'm trying to give you an overwhelming impact of this law is to help increase our production. Business interest deduction. A lot of different complex calculations there, but again, it's a loosening up of the modified calculation for adjusted taxable income for business interest deduction and what you can write off for business interest. So again, increased limitations for expensing certain depreciable business. So this is what we call the Section 179, right? So Section 1, when we were in the 60% area for the depreciation, a lot of us were trying to figure out, okay, how do we use the Section 179 to write things off faster? Well, now they've increased that tax rate up to 2.5 million, right? It was previously 1 million in Section 179. Obviously, with bonus depreciation, it's not as important, but it still can come in handy from time to time. Opportunity zones. Expands eligible areas of opportunity zones. God, you know, we really should love opportunity zones more than we really do, right? So, you know, an opportunity zone is where you can invest in a building, you hold it for 10 years, and there's no capital gains, okay? Really, really important, okay? And it's an area where you have no capital gains. You can basically buy this property, drain the depreciation as fast as you possibly can, hold it for 10 years, and sell it and have no capital gains, okay? There's tighter reporting. There's more focus on rural areas again to try to build areas where you need to be. You know, what if your rural area that you're using the low-income housing credits also qualifies for an opportunity zone? So imagine that, right? You develop low-income housing in a rural area that qualifies for these zones that are newly expanded, right? And they're going to last until 2033, right? So, and it offers bigger tax reductions of 30% or versus 10% for adjustments held more than 5 years. So they're really trying to, not only we're talking about manufacturing, we're also talking about building, right? And going forward. I think we talked about that. We talked about the R&D tax credit. Oh my goodness. International, I can't cut. We're not going to cover international, guys. We don't have enough international stuff. But there's good stuff in there as well. On tax incentives for small business manufacturing. This is also very interesting. You know, once a small business reaches 25 million, they're required to do accrual-based accounting. They're lifting that up to 80 million. Okay. And they're also having several other ways to adjust that annually for inflation and really, you know, and that 80% of the revenue must come from selling products and that the business physically makes or transforms. Again, what they're trying to do is give the advantage to smaller manufacturing businesses, right? They were originally, remember they were talking about they were going to lower the tax rate for businesses that are manufacturing, and they didn't do that, right? Instead, they're doing this, and they're doing a few other things to give some incentives to small business manufacturing owners. Let's remember what manufacturing is. It's the conversion, right? Could be machine shops, could be ag, whatever. Boy, excise and sales tax provisions. And the other thing I want you to know about this tax code, and again, we just basically run out of time. What I'm going to do is open the time up for some questions. How much time do we have left? We got about 2 minutes left. Oh my God. So let's open up for questions. How do I do that?
Sure. People can type in their questions.
There's a chat feature in case you have any questions or you want to record. And I will tell you as we're doing this, if anybody doesn't want to ask any questions, I'll just go on. You know, most of the clean energy stuff is terminated. Okay. So this tax bill kills a lot of clean energy stuff, including the solar tax credits for houses, right? So if you want to do solar tax credits, that is ended. Let me see if I can find this. That is ended. Termination of previously owned clean vehicle credit, termination of clean vehicle credit, termination of qualified commercial clean vehicles, termination of, I mean, it's all, they're getting rid of all the clean energy stuff, right? And ends tax credits, and check this out, ends tax credits for home renewable energy. The 30% tax credit for solar patterns, wind turbines, geothermal, and other non-residential clean energy ends December 31st, 2025. So if you have been thinking about getting solar for your house, now is the time to get that credit. It better be done by December 31st, 2025. There's no phase out period. It is over December 31st, 2025. Okay. This is going to be a major, and bear in mind, guys, it's almost June, right? And this could have a dramatic, I don't know what the impact is going to be to the solar business in general, but I mean, it has the potential to dramatically eliminate that business. So I would be concerned about it. Like it shouldn't. I don't know what it's going to. It should go down substantially. Boy, oh boy. Guess what? I'm out of time. I mean, we had 134 pages to go through. We didn't make it. A lot of these things in phase out of clean energy. This is like repeal and phase out, repeal, termination. The clean energy stuff is going away, right? So what we'll do is we'll send the full text of this slide deck. And I'm sorry, this has been pretty dramatic for me because, and I'm sorry, there's a lot to cover and a lot to blow through as fast as I possibly could. I tried to do it in an hour. It's great. If you really think about it, it's like 30 seconds a slide. Can't do it. But I did the best I could. So, but we'll send the slide deck to you. So to anybody that was here on the presentation, we'll send you the slide deck. A lot of really cool stuff. Overall, there's a lot of opportunities with depreciation. I think this is a time for us to expand. And if you are a business owner, it is time to expand. 100% bonus depreciation, opportunity zones, building real estate, doing other investments in low-income housing, the opportunity zones, the R&D tax credits, all of this in this tax bill. And tax bills are major areas of substantial reform in an economy. When the 2017 tax law hit and we had 100% bonus depreciation, the economy grew substantially, especially in the business area. If you were Amazon in 2017, when that tax law passed, you didn't pay taxes because you were dramatically expanding, buying warehouses, buying trucks, buying airplanes and everything, and writing it all off. Same situation. If you don't think Amazon and the big players are going to be gobbling up opportunity zone property, you don't think they're going to be taking 100% bonus depreciation, it's going to happen. And every single business owner that needs something new to expand their business should be able to take advantage of this tax law. So, I'm sorry this is so rushed, and sorry it is important. But sorry, I had to go so fast through this, and it's confusing. But if you have any questions on this, you can talk to us at any time. And we are going to include, for all of our clients, we're going to include basic training for all of our people once this bill passed, and redo everybody's tax plans to make sure we're including this all, and really do advising for a lot of our clients to make sure that they can be able to take advantage of this tax law. It's like I said, it's going to be an amazing time to grow and expand. If you have any thoughts about getting into the possibility of doing any type of manufacturing, it's going to be a great time to do it. I've never seen something where you're able to write off a production facility in its entirety in the first year, buy a production building and write it off. So who knows what opportunities could be. Like, for example, I'll bet you any amount of money that there's going to be people going out there, hey, how would you like to get in on building a production facility for whatever, for building, whatever they want, whatever you want to build, right? Parts, right? Or you want to build, like I talked about, you want to build a winery, right? Or you want to get into building a winery, so we'll buy a building, we'll write the whole damn thing off and pass that all through to you as part of a business that you're involved in. There's going to be substantial write-offs for the new tax law. Anyway, Peter Holtz, CPA, thank you very much for attending this session. I appreciate you, and everybody have a great weekend and good Memorial Day weekend.